Well, Mark Lackey joins us every week to talk about small cap opportunities in the Canadian Stock Exchange. For the most part, I don't think he's ever done anything outside of the state, outside of Canada, but so be it. Mark Lackey, CHF Capital Markets Executive VP, joins us now. And Mark, you and I have had an ongoing discussion about gold since you've been coming on here.
That's right, Pat. And Pat, you said $1,200 by the end of the year. Right now, I guess you're about $6 below. I had been saying $1,300. I have to be honest, I lowered my number to $1,250, so I didn't go all the way down to your level, but I'm sticking at $1,250 because I do think December seasonally is sometimes fairly strong, and I have a shot at that. But no question, on the year average, you're closer than me because you were a little bit
here's the
more
thing
pessimistic than I was.
Yeah, it wasn't so much pessimist. I'm realist, is what I am. Yeah. And here's a couple of things in terms of gold has collapsed through that 1,200 a couple of times now, right, and yet we don't get that capitulation sell-off. So there seems to be a latent demand for gold. Am I wrong in thinking that?
No, I think you're quite right, Pat. And let's look at some of the factors that have been taking place. The central banks are still buying gold. That's positive. The ETFs have been stopping their selling of gold, which is positive. This year was interesting because I think one of the things that gold demand, admittedly, is at a 4-year low. And what hit us this year was the sell-off of the demand decline in China. It was larger than I expected, particularly the jewelry sales were down as much as 37%. Mm-hmm. And I didn't anticipate that. I thought we'd get a bit of weakness given how strong things have been. But China surprised me. But the good news is our indications in the fourth quarter is that there's a recovery in gold demand in China, particularly in jewelry. India's hung in there in spite of the fact they still have that import tariff, which the Prime Minister has said he's going to get rid of. So, Pat, I do see some underlying factors here that I really think we've troughed, and I do think gold's going higher next year. I've got $1,350 to $1,400 at the end of the year, $1,450 to $1,500 by the end of 2016. Now, that's not a consensus forecast. I'm kind of on the upper end, but I believe that's where we're going. And as I said, I see some good demand reasons and some other reasons in the supply side that I think are going to help us get that to that level.
Here's the discussion, and I'm entirely in your camp. If anything, I might be a little bit higher in 2 years' time.
Which is interesting,
because I haven't seen that sell-off, and then I hear about, the argument I'm seeing out there from the gold bugs is, listen, central bankers, they've got weak currencies, they can't afford to buy gold. That's exactly when they do buy gold.
That's right.
And so that you look at Europe, for instance, their currency is weak. They say, where do I put my money? Right. Into the U.S. dollar? Now? After it's had such a big run?
It's had a huge run in the last 2 years.
So I think gold is a competing currency.
It absolutely is, Pat, and that's a good point because people keep suggesting that, well, it's either the U.S. dollar or gold. Well, in some cases that's right, but not in all cases. And I also point out that you look at the Middle East, where there's a lot of buying in gold. Well, they have a lot of U.S. dollars. And many of them are looking to do something different now with that U.S. dollar because of their very point you made. It's appreciated against almost every currency in the world except China. Yeah. And some of that currency appreciation, I would say, is unjustified. You look at India, it's got a good trade balance, same thing in Indonesia. I'm not quite sure why there's been this flight away from some of the countries there has been, but that's the reality. But at this point, I think the U.S. dollar can still get somewhat stronger against the yen and the euro over the next year or two, but I think it's going to flatten off against a lot of other currencies, and there are going to be people now looking to put their money from the U.S. dollar where they've made their profits and looking for an alternative. And I think you're right. Gold is one of the definite alternatives.
Yeah, and I'm not alone. As much as I don't like him, Putin has been buying gold for years now, and if anything, stepping up his efforts.
Yeah, the Russians clearly believe, and of course they're a fairly big producer of gold.
What about the supply side of the equation? So that's another concern, right?
Pat, that's right. And I think that you have to look at a couple of things. The people that look at $800 and $900, the problem is there's enough guys producing today at above those levels that they'd have to shut in. So I think the $800-900 camp on the supply side, I just don't see it happening. But the other thing we've seen, Pat, we've seen a big project in Peru got postponed, a big project in the Philippines has been postponed. So we're now and we have seen other companies, big guys, mid-cap guys, who have actually cut back on their production, cut back on their exploration. And we saw an interesting merger this week with the Cisco royalty taking out Virginia Mines. And they wouldn't have done that, certainly, if they didn't believe gold prices were at the bottom. That's why they made that move. So I think on the supply side, I see less supply than I would have forecast even myself a year and a half ago. And so, again, another positive for the price of gold.
Okay, so now let's get through some of these picks that you've got. Goldeye Explorations.
Yeah, Goldeye Explorations, interesting company, Pat. They had some incredible drill drill holes. And when you consider they went into a property that hadn't really had a lot of work done on it, to pull those kind of holes out on your first set of drill holes is not, it's not very often I've seen something quite like that, where you get, say, 12 grams over 3 meters, 12 grams over 7 or 8 meters, 23 grams over 4 meters. Some very good numbers they've pulled out initially. Now, of course, the market's going to want to see them do more work and expand it, and that's what they plan to do. But it's interesting. It's in Northern Ontario. I like the infrastructure. I like the management. I like the high grade. I'm not in some of the jurisdictions in the world which worry me right now, and that's one of the problems on some of these small caps is that, you know, if you're in a jurisdiction that's difficult and you have low grade, with this gold price, you've got a big problem. So I like what these guys have done. I also like the fact that they got the agreements with the Sandy Lake First Nations. That's extremely important. In fact, the minister mentioned this the other day, the federal minister, that he was noticed gold eye and he was pleased they were working with the First Nations. And so that's all positive. And, you know, the only thing I can say is that they pulled these numbers in a much better gold market, the stock price would be considerably higher.
Well, it's 4 cents. And I guess
right.
that's the question. I mean,
right.
It goes from 4 to 5 and you make 25%
Right.
of your dough. These things are not just small caps. They're kind of a micro cap.
Well, this is a
aren't they?
micro cap, Pat. And, you know, I got to be honest, I'm not following a whole lot of micro caps. Most of them have fallen out of my model. So somebody phoned me the other day and said, well, why is this one in there? And I said, well, Pat, you know, actually it was another Pat as well. I said, you know, it's met all my requirements. Like, if you look at that grade and you look at the management and you look where it's located, it's one of, you know, I might only have 4 or 5 micro caps that I still look at, because it's about 75% of my gold companies have fallen out of my model in the last year. So this one's there largely because those kind of grades are hard to find. And I've said before, you can't beat good grades. I mean, that's just the reality of the situation, and I think it's an exciting possibility given it hasn't been drilled a lot, and of course you're not that far from Red Lake, so it is a gold-bearing area up there in Northern Ontario, and it's good jurisdiction.
Okay, Kaminak Gold Corporation.
Yeah.
Am I saying it right?
Yeah, Kaminak's an interesting play, Pat, because these were one of the guys that went into the Yukon when we had that big Yukon gold rush back in 2010, 2011. And of course, gold hit $1,900 in 2011. And there must have been about 70 or 80 companies went in there. And of course, you know, Underworld got taken out for about 13, 14 times its value, so everybody thought they were going to be the next Underworld. As it's turned out, most people have found nothing and have left, but a few people have remained, and Kaminak has got high grade. They've done a lot of great drilling. They have a chance to, this coffee project they have, there's a lot more drilling capability. And I like the management. I've known the team now for about 3 or 4 years, and they've met their milestones, Pat. They're moving along with feasibility, metallurgy. They're getting closer and closer to becoming a producing mine, and you know, the more that they find, the more the production costs go down. So I think this is another one that's going to be a good leverage play to a higher gold price.
Okay, Northern Ontario, good, nice position. Yukon, are they a friendly jurisdiction?
Yeah, the Yukon's very friendly. And the other advantage I should point out, Pat, parts of the Yukon are difficult, parts are not. Depending on where you are, some are all year round, some are, you know, isolated, and it costs you a lot more money to get people in because these guys are closer to a bigger town and they're closer to, you know, ways to move the barges and everything in, the costs are much lower. So that's the other thing that's attracted me, is that where they are operationally makes a lot of sense compared to, say, some other parts of the Yukon.
Okay. West Dome Gold Mines.
Well, you know, West Dome, of course, some people are going to say, boy, that's been around for a while.
I was going to say, I
gold for 25 years.
I remember that name.
You know, they're Wawa, they're Valdor. What I like, Pat, is that these guys are survivors, and what they've done recently is now they've been able to increase their gold production in the last year. They've increased their cash flow. They've lowered costs. They have some other very good opportunities in Val-d'Or. They have another good opportunity west of Thunder Bay. So again, I think this is a really good leverage play here. We're sitting in Quebec and Ontario, veteran management team, and they were smart. You know, at one point, Pat, a few years ago when the price took off, a lot of people were saying to them, hey, drill a lot more, do a lot more work. They were steadier, you know, slow and steady wins the race. And it ended up being right, because we now know what's happened to the gold price. And unfortunately, there's been some companies, Pat, or a number of them, that drilled so much, didn't find as much, and now they're sitting on high cost gold, and what are they going to do with it in the short run? So Wesdome, you know, they have gone along this slow, steady performance, but I like the fact they're sitting really in a good position now, especially if gold prices do what we both think they're going to do in the next 2 years.
Well, that's interesting, because when you look at some of these gold mines that have been around for a long time, they don't have the inflated costs that we're looking at to get something up and running. So all they have to do is get it out of the ground.
That's a perfect point, Pat. And as I said, there were people on the street pushing them to develop a few plays that would have cost them a lot more money, and they said, you know, we're just increasing production from Val-d'Or and from Wawa, the places we know. And, you know, I think if they thought if prices had continued to go up, they would have done a bit more work on some of their other areas. But it's turned out their strategy worked because they're still around. They haven't been beat up that much compared to a lot of people. And now I see them as, you know, a really good leverage play to higher prices because they've got their costs under control.
Okay, well, funny enough, Mark, we now agree on the gold price in the future.
We'll have to see what we disagree on then.
Yeah, exactly. $12.50 by the end of the year. You know, you might get that $100 or something like that sell off.
You know, I could, Pat, because, you know, seasonally December is pretty strong, and, you know, I'm really only looking at another $60, $70 here, but, you know, it's been in somewhat of a downward trend, as we know. So it will be interesting to see what happens on a monthly basis. But I'm really looking out more what I think will happen in the next 12 and 24 months, where you and I are in pretty much agreement.
Yeah, I think
and
so too.
Admittedly, Pat, we're not the consensus.
No, because the consensus has gone to $800 or $1,000, whatever it is. And when everybody goes one way, I'm looking the other way to make sure.
I think there's a lot of truth to what you're saying, and we've already shown why we think on supply and demand the $800 to $1,000 case doesn't seem. I think there's more likelihood it will be in $1,600 in 2 years, which is somewhat higher than my forecast than the $800 case.
Yeah, I'm in the 1,600 camp, Mark. Great to have you, though. Mark Lackey joining us, CHF Capital Markets Executive VP. Coming up, though.